Learning module, alternative investment performance and returns. Topic: alternative investment performance. A hedge fund has 600 million GBP in equity capital. It borrows 300 million GBP at an annual rate of 5.0% and achieves a levered return of 18%. The underlying unlevered return on the total asset portfolio is closest to A. 13.7%, B. 15.5%, C. 21.0%. A private equity fund uses discounted cash flow models to value its portfolio companies quarterly. Over time, the fund's reported quarterly returns show low volatility and steady appreciation, even during a broad market downturn. A due diligence review finds that model inputs, for example, discount rates, long-term growth assumptions, have not been updated despite deteriorating industry fundamentals. The most likely consequence of this practice is A. Overstatement of management fees, B. Understatement of portfolio risk, C. Violation of fair value accounting standards. A venture capital fund reports a terminal value of $600 million. The investors initially provided $400 million in paid-in capital. If the fund incurred $40 million in management fees and $20 million in other funds-related expenses during the investment lifecycle, the multiple of invested capital, MOIC, is A. 1.35 times, B. 1.50 times, C. 1.76 times. An event-driven hedge fund holds a portfolio of convertible bonds, long positions, and has sold short a basket of the underlying common stocks as a hedge. At month end, the fund's administrator is responsible for calculating the net asset value. The administrator aims to apply the most conservative valuation methodology in accordance with fair value accounting standards. To achieve this, the administrator should value the A. Convertible bonds using ask prices and the short stock positions using bid prices. B. Convertible bonds using bid prices and the short stock positions using ask prices. C. Convertible bonds and the short stock positions using the average of the bid and ask prices. The leveraged rate of return, RL, is calculated by dividing the net profit by the cash position, VC, which represents the investor's actual equity, rather than the total value of the assets. Because the unlevered return, R equals 13.67%, is higher than the borrowing rate, RB equals 5%, the leverage magnifies the return, resulting in a significantly higher leveraged return. RL equals 18%. Both formulas, original and rearranged, are mathematically equivalent and useful depending on which variable is unknown. The spread, R minus RB, determines whether leverage amplifies gains or losses, not just the calculation, but the relationship between asset return and borrowing cost. Leverage magnifies the difference between R and RB, not the absolute return itself. This leverage principle applies across all alternative investments, such as hedge funds, private equity, real estate that use borrowed funds. Failure to update model inputs creates artificially smooth net asset values. Reported risk metrics such as standard deviation, beta, VAR, appear lower than true economic risk. Investors are misled into believing the portfolio is less volatile and less correlated with markets. Level 3 assets require scrutiny because valuations reflect estimates, not observable transactions. Option A, fees. Inflated net asset values could affect fees, but that's secondary. The curriculum emphasizes that the main issue is risk understatement. Option C, accounting rules. Using models for level 3 assets is allowed under fair value standards. The problem is whether assumptions are updated and reasonable. Higher interim net asset values help GPs clear hurdles and earn carried interest, creating motivation to delay write-downs. Risk understatement distorts portfolio construction and leverage decisions more severely than fee overstatement. Level 1, mark to market, is observable, reliable. Level 3, mark to model, is unobservable, discretionary, prone to smoothing and bias. If returns look unusually smooth during market stress, suspect level 3 inputs. The systemic issue is understated risk, not overstated returns. MOIC measures returns only on the capital actually deployed into investments after subtracting management fees and fund expenses. It is not based on gross committed or paid in capital. Always adjust paid in capital for fees and expenses before calculating MOIC because it measures performance on invested capital, not total contributions. Paid in capital is cash contributed. Invested capital is what remains after fees and expenses and is actually deployed into assets. MOIC ignores time entirely. Two investments with identical multiples but different holding periods have vastly different performance, yet MOIC shows the same number. Early negative returns, fees plus capital calls, occur before assets are sold, making time-adjusted measures, IRR, more meaningful than simple multiples. Useful for total wealth creation snapshot, but must be supplemented with IRR for proper performance appraisal. Long positions use bid, lowest selling price. Short positions use ask, highest buying price. This reflects realistic liquidation values. Valuation depends on position type. What is conservative for a long is aggressive for a short. Midpoint is common but not conservative. It assumes favorable execution at the average rather than actual exit prices. Conservative valuation aligns with fair value's exit price notion for both assets and liabilities. Long positions use bid prices, lowest sellable price. Short positions use ask prices, highest repurchase cost. Conservatism principle prevents overstating assets or understating liabilities. Midpoint or average is convenient for reporting, but not conservative since it doesn't reflect actual exit values. Always apply bid for longs and ask for shorts to ensure valuations reflect realistic, conservative fair value. Topic: alternative investment returns. A hedge fund has prior year AUM equals 200 million. Gross return equals 30%. Management fee equals 2% of year-end AUM. Incentive fee equals 20% calculated net of management fee. High water mark equals 255 million. Soft hurdle rate equals 6%. Total fee earned in the current year is closest to A. 5.20 million. B. 6.50 million. C. 7.80 million. A hedge fund has 3 investors. Investor F invests 100 at year 0. Investor G invests 100 at the beginning of year 2. Investor H invests 100 at the beginning of year 3. Gross returns. Year 1 equals 30%. Year 2 equals negative 25%. Year 3 equals 20%. Year 4 equals 12%. Management fee equals 1.5% of end-of-year value. Incentive fee equals 20% above high watermark, calculated on value net of management fee. Which investor has the highest net return at the end of year 4? A. Investor F. B. Investor G. C. Investor H. Venture Growth Partners is a private equity fund with the following terms. Total capital commitment $150 million. Preferred return 7% per annum, soft hurdle. Carried interest 25% with full catch-up. Waterfall, American, deal by deal, with clawback. Management fees, none. The fund completed for investments. Portfolio Company A invested $50 million in year 0, exited for $72 million in year 3. Portfolio Company B invested $30 million in year 1, exited for $38 million in year 5. Portfolio Company C invested $40 million in year 0, exited for $76 million in year 4. Portfolio Company D invested $30 million in year 2, exited for $24 million in year 5. The total carried interest earned by the GP is closest to A. $13.00 million, B. $22.0 million, C. $15.3 million. Growth Capital Fund has these terms. Capital committed equals $180 million. Preferred return equals 7% per annum, soft hurdle. Carried interest equals 25% with full catch-up. Waterfall equals European, whole a fund. Management fees equals none. The fund made 3 investments. Investment X, $60 million, $90 million in year 3, profit $30 million. Investment Y, $60 million, $75 million in year 5, profit $15 million. Investment Z, $60 million, $105 million in year 5, profit $45 million. Totals: invested $180 million, sold $270 million, profit $90 million. What is the total carried interest to the GP? A. $22.5 million. B. $18 million. C. $20 million. A hedge fund has $450 million in assets at the beginning of the year. Its fee structure includes a 1.5% management fee based on year-end AUM, a 15% incentive fee with a 5% hard hurdle rate, and a high watermark of $465 million. At year-end, the fund's value before fees is $520 million. The net percentage return to an investor for the year is closest to A. 12.5%, B. 13.5%, C. 14.2%. A hedge fund has the following fee structure. Initial assets $120 million. End of period assets before fees $132 million. Management fee 2% of year-end AUM. Incentive fee 20% of profits. Soft hurdle rate 6%. No deposits or withdrawals occur during the year. Management fees and incentive fees are calculated independently. The net of fees returned to the investor is closest to A. 8.0%, B. 6.7%, C. 5.8%. Summit Ridge Fund begins the year with assets of $300 million. At year-end, assets under management are $336 million before fees. The fund charges a 2% management fee based on year-end AUM and a 15% incentive fee. Both fees are calculated independently. The effective net return to the investor is closest to a 10.2%, B 9.0%, T 7.96%. An analyst reviews the following hedge fund information. Beginning of year AUM $100 million. End of year AUM before fees $112 million. Management fee 2% of year-end AUM. Incentive fee 20%. Soft hurdle rate 6%. Fees calculated independently. The total fees for the year are closest to A. $3,040,000. B. $4,640,000. C. $2,240,000. A hedge fund begins the year with assets of $120 million. It charges a management fee of 2% based on year-end assets and an incentive fee of 20% calculated independently. The fund uses a high water mark provision. Fund values before fees are $138 million at the end of year 1, $126 million at the end of year 2, and $150 million at the end of year 3. The net of fees return earned by investors in year 3 is closest to A 13.2%, B 14.6%, C 16.1%. A hedge fund has the following characteristics. Beginning of year assets under management AUM $150 million. Annual gross return 10%. Management fee based on end of year AUM 2%. Incentive fee 20%. Hard hurdle rate 3%. If the incentive fee is based on returns net of management fees, total fees for the year are A. $4,740,000. B. $4,500,000. The $5,212,000. A hedge fund begins with $80 million. It charges a 2% management fee on end-of-period AUM and a 25% incentive fee calculated independently. The fund uses a high water mark provision. Historical values are Year 1, before fees $92 million, after fees $85.8 million. Year 2, before fees $86 million, after fees $84.3 million. Year 3, before fees $105 million, after fees. The total fees earned in year 3 are closest to A. $4.50 million, B. $5.25 million, C. $6.90 million. High water mark rule, HWM, blocks incentive fees unless net AUM after management fees exceeds the prior peak. Management fee is deducted first from year-end AUM. Even with strong gross returns, our hurdle rate met, no incentive fee is paid if AUM after fees is below the HWM. This ensures managers only earn performance fees when investors' net value truly surpasses previous highs. High water mark check always comes first in the fee calculation sequence. Incentive fees are only considered if net AUM after management fees exceeds the HWM. The hurdle rate, soft or hard, only matters after the HWM is surpassed. The step-by-step order ensures clarity. Compute gross AUM, deduct management fee, compare to HWM, check hurdle, calculate incentive fee, sum total fees. Even after 4 years in a positive overall trend, Investor F's ending NAV 117.9 fall remains below the year 1 HWM 122.44. The calculation confirms 117.94 minus 122.44 is negative, so zero incentive fee despite a 12% gross return in year 4. 17.94% represents the actual investor experience. All gains after year 1 were earned without paying performance fees. A single strong year can create a HWM that persists for multiple periods, protecting investors from paying fees on subsequent recoveries. Year 2 to 4, even with partial recoveries, the NAV after fees remains below the HWM. No incentive fees are triggered, and the investor ends with a net loss of negative 3.68%. Managers cannot collect performance fees until the NAV surpasses the investor's original peak value. HWM ensures incentive fees only apply when post-fee NAV exceeds the prior high, safeguarding investors during drawdowns. Year 3. Strong gains set a new HWM at 114.56, triggering incentive fees. Year 4, NAV after fees again, exceeds the HWM, so incentive fees apply. Investor H earns the highest net return, 24.02%, compared to earlier investors. Timing matters under HWM structures. New investors, after a drawdown, avoid old HWMs and can capture higher net returns when recovery occurs. Carried interest is only earned when profits exceed the preferred return. Company A, profit exceeds preferred, GP earns $5.5 million. Company B, profit does not exceed preferred, GP earns $0. Preferred return is the first hurdle. No carry interest if profits don't clear it. GP earns carry when profits exceed preferred return, but clawback reduces carry when later deals lose money. Company C, profit exceeds preferred, GP earns $9.0 million. Company D, loss. Clawback of $1.5 million. Total GP carry, $13.00. Clawback ensures fairness by offsetting losses against prior carry. American waterfall. Each deal is evaluated independently, deal by deal. Soft hurdle and full catch-up, GP earns carry on the entire profit once the hurdle is cleared. Clawback clause protects LPs by requiring GP to return carry to offset later losses. Preferred returns are typically calculated as simple interest, capital multiplied by rate multiplied by time, rather than compounding annually. In a European waterfall, carried interest is calculated at the whole fund level, not per deal. Preferred return is aggregated across all investments, $54.6 million total. Total profit, $90 million, exceeds aggregate preferred return, $54.6 million. So the hurdle is met at the fund level. This unlocks GP's entitlement to carry under the soft hurdle structure. With full catch-up, GP first receives enough to reach 25% of profits, then shares the remainder. This results in GP carry of $22.5 million, exactly 25% of total profits. Soft hurdle plus full catch-up ensures GP ultimately gets 25% of all profits once hurdle is met. European waterfall nets all deals together, so weaker investments don't block carry as long as the fund overall clears the hurdle. The 1.5% management fee is calculated on the gross year-end AUM, $520 million, and must be deducted before calculating the incentive fee. In a hard hurdle structure with a high watermark, the incentive fee is only paid on gains that exceed the higher of the two thresholds. In this case, the hurdle-adjusted initial capital, $450 million times 1.05 equals $472.5 million, is higher than the HWM, $465 million, making $472.5 million the required floor. The 15% performance fee is only earned on the excess amount where the NAV after management fees, $512.2 million, surpasses that $472.5 million hurdle threshold. The final net percentage return, 12.5%, is determined by the fund's growth after all fees have been deducted relative to the investor's beginning of year capital, $450 million. Because the $12 million gross profit exceeds the $7.2 million soft hurdle, 6% of initial capital, the 20% incentive fee is applied to the entire profit, $12 million, rather than only the profit in excess of the hurdle. This results in an incentive fee of $2.4 million, which, when combined with the management fee, leads to the final net return of 5.8%. The management fee and incentive fee are calculated as separate outlays from the same gross year-end value, meaning the management fee does not reduce the profit base used to calculate the performance fee. This aligns with the soft hurdle principle, where the manager is rewarded for the full magnitude of the gain once the minimum performance threshold is cleared. When fees are calculated independently, the 2% management fee is based on the total year-end assets, $336 million, while the 15% incentive fee is based on the full gross profit, $36 million. Because they are independent, the management fee does not reduce the profit figure used to determine the performance fee. Independent calculation creates a layer-in effect where multiple fees are subtracted from the same gross return, significantly eroding the investor's net gain. This specific structure is less favorable to the investor than a net of management fee structure, as it leads to a higher total fee and a lower effective net return, 7.96% versus the gross 12%. Gross return, 12% exceeds soft hurdle, 6%, so incentive fee applies to entire profit. Management fee is $112 million multiplied by 2% equals $2.24 million. Incentive fee, soft hurdle, independent, is $12 million profit multiplied by 20% equals $2.4 million. Total fees is $2.24 million plus $2.4 million equals $4.64 million, matches option B. Both fees calculated separately on gross figures and then added. Soft hurdle rule. Incentive fee on all profits once hurdle exceeded, $12 million times 20%. Contrast with hard hurdle would apply only to profit above threshold. Independent versus net of fees calculation methods affect incentive fee base. Year 1 established HWM at $131.64 million after fees. Management fee $2.76 million and incentive fee $3.6 million calculated independently. Initial HWM set the threshold for future incentive fees. Year 2, value fell below HWM, no incentive fee, only management fee, $2.52 million. HWM remained at $131.64 million, unchanged. Year 3, incentive base is $150 million minus $131.64 million. HWM equals $18.36 million. Incentive fee is $18.36 million times 20% equals $3.672 million. Management fee is $150 million as 2% equals $3.00 million. Total year 3 fees is $6.672 million. Beginning year 3 capital is $123.48 million after year 2 fees. Ending year 3 capital after fees equals $143.328 million. Net return is $143.328 million minus $123.48 million, divided by $123.48 million equals 16.1%. Matches option C. HWM ensures incentive fees only apply to gains above prior net peak. Key process. Track net capital after fees. Update HWM only when new net peak reached. Management fee always on year-end OM. Incentive fee equals end O minus HWM multiplied by incentive percent when independent. Net return uses beginning and ending capital after fees. Management fee is always calculated on year-end AUM, $165 million times 2% equals $3.3 million. Incentive fee is based on net profit after management fees, but only on profits above the hard hurdle $4.5 million. Incentive fee is $11.7 million minus $4.5 million multiplied by 20% equals $1.44 million. Total fees is $3.3 million plus $1.44 million equals $4.74 million. Net of management fees equals management fee deducted before incentive fee calculation. Critical sequence: end in AUM, deduct management fee, calculate net profit, apply hurdle, calculate incentive. Hard hurdle means incentive only on profit above the hurdle threshold. Hard hurdle means incentive fees apply only to profits above the hurdle threshold, not to all profits once exceeded. Net of fees calculation order and the hard hurdle restriction. Ensure total fees are $4.74 million. Answer A. HWM identified as highest previous after fee value is $85.8 million. Year 1. Year 3 before fees, $105 million exceeds HWM. Incentive applies. Management fee is $105 million times 2% equals $2.10 million. Incentive base is $105 million minus $85.8 million. HWM equals $19.2 million. Incentive fee is $19.2 million times 25% equals $4.80 million. Total fees is $2.10 million plus $4.80 million equals $6.90 million. Matches option C. Management fee calculated first on end of period AUM. HWM is the highest previous after fee value, not before fees value. An independent calculation, incentive fee based on gain above HWM, not reduced by management fee. Prevents double dipping after losses. HWM uses prior peak NAV, hurdle uses minimum return threshold. Independent is incentive calculated separately, not net of management fee. Incentive fee equals current before fee AUM minus HWM multiplied by incentive rate. Sequence: management fee first, then incentive fee on gain above HWM.